Hey, what's up, stock compounders? Brad here. So today I want to talk about a recent blog post put out by Nick Sleep called Short-Term versus Long-Term Thinking. I first came across Nick Sleep in this book, Richer, Wiser, Happier by William Green. He has a chapter in this book dedicated to his time at the Nomad Investment Partnership, which ran from 2001 to 2014. And that fund did incredibly well. I think it was a 20.8% annualized return versus 6.5% for the index. So absolutely crushed the index. But perhaps the most notable thing about this fund was towards the latter years, there were really only 3 or 4 holdings in the fund. Okay, so to generate those kinds of returns while only having 3 or 4 stocks, that is the Holy Grail of investing. So, Nick Sleep and his partner, Case Zakaria, really stumbled upon something here worth integrating. And that's really focusing on long-term thinking. And they were able to identify just a couple businesses that really were steeped in this long-term thinking. So I want to go through this blog post here, this article on the Iggy Foundation website, and then I'm going to point to a few other resources as we go through this. How to think short-term versus long-term. So you can see on the left side here, short-term characteristics, on the right, long-term. We have inputs, causes on both sides. So I'll point out a few of the things here. Comfortable with win-lose trade-offs. Okay, there's really an emphasis on how do I get the biggest bang now? Okay, and without any regard really for the other guy. Impatience, right? Want a fast payoff. Works from secondhand opinions. Commission-based pay. Transaction deal-oriented, compulsive expedients, right? Obviously, these are very short-term oriented inputs and causes. Move to the right side, okay? Principles, right? Win-win orientation, patient, works from primary data first principles. Quality is everything. Nick Sleep talked a lot about quality in his letters. Seeks relationships as opposed to being transaction oriented. Defers gratification. Gives. Okay, this give and take is such a theme between short-term and long-term thinking. Outputs and effects, right? What do these inputs result in for the both short-term and long-term thinking? You have a moat that gets drained, right? So you're pulling from the future when you have this short-term orientation. Rents versus owns. I'll just kind of skip back and forth between these pairings here. Harvests, plants, right? So again, short-term is all about what's in it for me. Planting, you're planting for the future. So I'll let you guys read through a lot of these, but I'm just picking out a few. Fragile, anti-fragile. Nick Sleep, being based in the UK, Brexit versus enlightened, win-win. 1 + 1 = 2, compound interest, right? Long-term, really whenever an investor is talking about long-term, usually they're talking about long-term compounding. And there's a reason you've got compounding here in the long-term column and a simple 1 + 1 = 2 in the left side. Scale economics kept, okay? The benefits of scale are kept for the company, for the shareholders, not so much for the customers. With long-term, scale economics are shared. And we're going to get into that a little bit when we go a little further down. Who, right? So this talk about who tend to be short-term thinkers, who tend to be long-term thinkers, right? Long-term, there's a reason a lot of investors are, compelled by founder-led companies, okay? Because there's this inherent long-term thinking. When the person who's running the company, right, it's their baby. It's not this get-rich-quick scheme. It's a business that they believe in, and so they run it that way. And then we talk about companies down here at the bottom. Turn of the millennium, Fannie Mae, Freddie Mac, AIG, GE, Enron, probably include FTX down there, short-term thinkers. Long-term, Costco, Berkshire Hathaway, Amazon, okay? These are really the three companies that formed the majority of the portfolio for Nomad towards the end of those fund years. Interestingly enough, these are Iggy Foundation's holdings as of September 30th of 2022. Hasn't changed, right? This is basically what they held as they closed the portfolio, and they still own these companies, okay? Just speaks to the incredible staying power of businesses that are so steeped in long-term thinking, Amazon, Costco, and Berkshire Hathaway. Now, I will add, Nick Sleep owns ASOS still, right? Even as the share price has tumbled over the last year, maybe 2 years, with the management turnover and despite all of the issues with the company, sounds like Nick Sleep still holds his stake. His stake has remained unchanged since he trimmed Amazon by half and put that money into ASOS. So, this kind of gives you a nice checklist of how to differentiate short-term behavior, short-term thinking from long-term. So we'll just skim through this. Perhaps old habits die hard as we start these observations on short and long-term thinking with some business analysis. For most companies to thrive over the long term, one constituency must be looked after before all others, and that is the customer, okay? And it's pretty clear. I mean, if you look at Costco, Berkshire Hathaway, and Amazon, there is such a heavy customer focus, customer orientation from these businesses. I used to be a Geico member, and I felt it there. I used to go to Costco. I moved to Asheville. There's no Costco here. There's a Sam's Club. It's not as good. I really liked Costco. And then, of course, Amazon. I mean, basically, whenever I think of buying something, I go to Amazon first. So incredibly powerful brands, those three. And largely because they have this customer focus. We believe that if a firm's relationship with its customers is profitable and enduring, that will provide the cash flow to pay a decent salary to employees, a fair price to suppliers, a dividend to shareholders. The tax people can have theirs, and crucially, something is still left to reinvest in new and better products, right? So everyone in the ecosystem of the business wins. A self-reinforcing virtuous spiral. So this is a sketch by Jeff Bezos, right, in the 90s. His model for Amazon illustrates how better products lead to happy customers, lead to more cash flow, which again leads to better products, to more customers, and so on. So it's this flywheel of scale economies shared that Nick Sleep and Case Zakaria talked so much about in their Nomad partnership letters. So it's this growing ecosystem of win-win relationships. For those of you familiar with Peter Kaufman, he talks a lot about win-win relationships. For those of you who don't know, he basically put together Poor Charlie's Almanac. a guy who really flies under the radar. I highly recommend digging into Peter Kaufman as well. He does have a few things in the public domain. It's hard to do and takes patience, right? Growing this ecosystem of win-win relationships and a certain orientation and discipline, but when it works, it's a beautiful and very profitable model. Now, it's hard to do because there's, so many people who are impatient, right? And there's a lot of parties that go into running a business. And if you don't have all of these parties coming to the table with this long-term orientation, there are very strong external pressures to align in a more short-term way. So that's part of why it's hard to do. He talks a little bit about the financing of a charity here, the difficulties of that. Pabrai would agree with this. Monish Pabrai would say it's a lot easier to make money than it is to give it away in a productive way. Zach and I wrote a fair amount about mistakes in the Nomad Letters, which can be found on the Iggy website, in which we discussed how mistakes often result from overweighing an apparent short-term win without fully recognizing the consequent long-term cost. Okay? It's going after this short-term, hit and really not realizing that the vast majority of time you're borrowing from your future success when you do that. The long-term cost. We all do it. List of common mistakes: snacking on chocolate cake, smoking, drinking, drugs, lying, stealing, cheating, all represent a short-term high/convenience while borrowing something from the long term. Companies are not immune, right? Firms that cut vital investment spending to protect this year's profits or make acquisitions to plug revenue growth holes are borrowing from their future, right? They're making today look better, look rosier, but at the cost of tomorrow. Businesses can be well run or poorly run, but in our opinion, the distinction between good and bad is often synonymous with long-term or short-term orientation. Long-term good, short-term bad. Now, it is very valuable to have something so concise. This is a very concise rule, okay, that can be applied, whenever a decision has to be made. So it's incredibly powerful. The first time I read through this, I thought, well, that's kind of obvious. It's very simplistic, but it's incredibly powerful, okay? So it's well worth really trying to integrate these lessons and be able to quickly identify, okay, where am I acting with short-term thinking and where am I acting with the long-term in mind. Just to wrap up here, in the morning of the Berkshire Hathaway annual general meeting, the firm shows a 20-minute video containing clips from the last 50, 60, 70 years. Hopefully we have many more years of this. In one clip, perhaps from the 80s, Buffett is asked how he differs from other investors. And he provides a one-word reply: patience. Okay? What is patience? If we can distill it down. Patience is a product of confidence and trust. Now, if Zach and I are not confident in our analysis, or we don't trust the other guy or gal, then without those two bedfellows, what is the case for being patient? Okay? So it's not enough to be blindly patient. We can't just throw a bunch of things in the portfolio and say, okay, we're just going to let that ride for 10 or 20 years. The things in the portfolio need to deserve our patience. They need to have that long-term orientation. Okay? And he talks about it here, without no patience, there is no force preventing the drift towards short-termism, with all the mode-draining behavior that implies. So what deserves patience? In our opinion, reasoned confidence, deserved earned trust, and resultant patience is what seems to be lacking in so many businesses. Peter Kaufman, there he is again, really came out with this definition: confidence and trust. So we have the short-term characteristics and long-term alternatives. The list is not exclusive, but it may be a start of a map away from the worst moat-draining activities and behaviors towards a more rational and fruitful allocation of time and resources. Charlie Munger would ask, don't we all want to live in a seamless web of deserved trust? We hope the checklist may be of some benefit to you in spotting and avoiding the worst of the short-term folly. Now, as I was reading through this, I thought of Todd Combs' recent breakfast, sitting down with Michael Mauboussin at the Graham and Dodd annual breakfast. And I just want to pull out a little section here. Charlie famously says, you get what you incentivize. If a management is incentivized to appeal to Wall Street, it might behave in a value-destructive way. Todd Combs said that it's a red flag if a company is too focused on external relations. Combs mentioned how his responsibilities are great and his time is scarce, but if he was 150% dedicated to analyzing companies, here's the point I want to make here, he'd focus on delta reports and see what management is changing from year to year. Okay? A big signaling effect for Combs is when management changes the key performance indicators, KPIs, for which it will get compensated by, presumably because management won't get compensated if the KPIs are left as is. So, when Combs looks at these delta reports, I guess which quickly show what changes from year to year in the annual reports, and what management is changing. If they're changing their KPIs, presumably to get some bonus, they really focus on the short term, right? They're focused on, all right, how do I get mine this year? And if you're seeing that through delta reports, that's a pretty big red flag that management is very focused on the short term, the benefits in the short term, at the expense of long-term gain. So this really caught my attention. If any of you know where to find delta reports, let me know. I'm pretty interested to dig into this a little bit. Combs estimates that in the Fortune 500, approximately 20% of companies are changing the incentive metrics for management. Okay, so that really jumped out at me with this Todd Combs annual breakfast. But anyway, guys, just wanted to share this stuff with you, and of course, drill it into my own head, because this is very powerful stuff. Don't let the simplicity of it fool you. It's very powerful for investors like myself. So, hope you enjoyed that. Let me know what your takeaways were. If you had anything a little different from this article, short-term versus long-term thinking. And that's it, guys. Hope you enjoyed it. I will see you all in the next one. Take care.